and this is going to be the top 5 most asked questions that we get on social media or from our members inside of chat. And let's go right through this. Question number 1 that I get from everybody the most is, how important are earnings and guidance this week, and what should I be paying attention to so that I can identify opportunity? That is one of the questions that we get asked the most. So what I'm going to do, all right, for that, give me 1 second, guys. Let me pull up my charts. So the recession is now, right? Everyone's talking about the recession is now. If we're not in a recession already, you're getting one here real soon. So what do we need to be paying attention to this week when it comes to earnings? Okay. What is it? What do we need to be paying attention to? You had the markets come down the first half of the year because of inflation and because of the Fed raising interest rates. That was the first move to the downside. But now what the problem is that you have to look at earnings now to see if companies start guiding lower. Now, you had a couple of companies come out last week with earnings, and earnings were actually really good. Citigroup was fantastic. Taiwan Semi was fantastic. Some really good earnings coming from those companies. But that's just a handful. You're about to get an onslaught of earnings coming out from a lot of these companies in the S&P that's going to be coming out here this week. The next 2 weeks are going to make or break. Okay, everyone wants to know, is the bottom in? Well, the next 2 weeks, these companies are going to tell you if the bottom is in for 2022, because you got really good data at the end of last week, really good economic data. You had a consumer sentiment number that was actually much higher than was expected. You had retail sales numbers that were much higher than expected. And you have what looks to be inflation numbers that looks like they peaked in June. And we're going to find that out in July, because I'm telling you guys this, you saw commodity prices get absolutely crushed in June. Oil, natural gas, nickel, copper, aluminum, wheat, corn, all of it down 20%, down 30%. The price of gasoline at the pump. You guys go to the gas station, you fill up your gas tanks. You've probably noticed a 30, 40, 50% drop in the price of gasoline. Those are all good things that can help bring down inflation. Where inflation really is a problem is rent. Rent prices are a massive problem for inflation. Now, rent makes up 30% of CPI, which is the Consumer Price Index, which is a major inflationary signal and a major inflationary indicator. 30% of it is in rent. And since rent is going up at a pace of 1% a month, yes, you heard me correctly, 1% a month. New York City just had an all-time record high. The average rent per month in New York City is $5,058. That's insane. All-time record high. That's the average. The average. Okay. So on Friday, you got really good economic data. Consumer sentiment was higher than was expected. It was expected to be at 50.0, which is an extremely low number. It came in at 51.1. Retail sales numbers came in better than expected. Jamie Dimon came out with earnings and said the consumer is still in a strong place, that small business credit is still in a really good position. Then Citigroup comes out, and Citigroup beats revenue by over $1 billion. And then you got Taiwan Semi actually raises their guidance going into the second half of the year. That is the exact opposite of what the news is telling you is going on. Literally, that's the exact opposite. Now, I also do not think that that's what you're going to get over the next 2 weeks. I think you had individual, some outlier names there with some of the banks and financials that they did pretty well. But now that you start to get into the heart of the S&P companies that are going to report earnings over the next 2 weeks, I don't think these earnings are going to be good. Well, let me rephrase that. Instead of earnings, it's the guidance that we have to worry about. Nobody's going to really care about the earnings. The earnings are most likely going to be good because the consumer and the economy was actually still pretty strong in the first few months of the year. In Q1 and Q2, even though the stock market was going down, consumers were still spending like crazy. You probably have good earnings, but where we need to pay attention is the guidance going forward. That's what you have to pay attention to identify the opportunity. It's the guidance going forward. Do companies say, yeah, our earnings in Q2 were great, but we're going to revise our guidance lower for the rest of the year? Do companies say that? We're guiding lower rest of the year because we anticipate a recession. We're going to find out on July 28th. A lot of people think we're already in a recession. You're going to find out July 28th. July 28th, you're going to get your GDP numbers for Q2. You already got a negative 1.6 number for Q1. If you get another negative number for Q2, that confirms that you're in a recession right now. Now, I hope that that actually is the case, because the sooner you go into the recession, the faster that we can come out of it. And I really do hope that we're already actually in a recession. That would actually, I think, be fantastic if we actually already are in a recession. So I'm actually looking forward to that number. But you guys got to realize that a huge reason why we got negative GDP is because of inventories, consumer spending, and retail investment, and all these other areas that have to do with the consumer. When you look at the last GDP number, it's actually, those things are actually net positives to GDP. A recession that is caused because of rising inventories and their effect on GDP and lower government spending's effect on GDP. Now, that's a pretty wacky recession. So yeah, could you still get a negative GDP print for Q2? Yes, you absolutely can. And that would confirm the recession. But the last numbers that you got, the consumer makes up 70% of the US economy. 70% of the US economy is the consumer. Okay. The technical definition of a recession: 2 consecutive quarters of negative GDP growth. That is the technical definition of a recession. So if you get it, great. We're already in it. Fantastic. Consumer remains strong. Are they weakening little by little because of inflation? Of course. The average consumer is spending an extra $400 to $500 a month right now on the same exact stuff that they were paying for a year ago. Only now they're paying 9% more on all of those things. It comes out to about $400 to $500 a month additional from what people were paying for last year. So yeah, eventually that will do some damage and that will crack. But the consumer was coming from an extremely cashed up, very liquid state coming into this, with a job market that gives you nearly 2 open jobs for every 1 person looking for a job. And that, my friends, gives you a tremendous buffer in a slowing economy. Recessions get bad when unemployment rises at a rapid pace and gets to a very high number. You get inflation, you get unemployment up to 6%, 7%. You get that number up to there. Yeah, that is when the recession really starts to hurt. But right now, you've got unemployment at 3.6. And don't forget, almost 2 open jobs for every person looking for one. Now, that's not going to stay that way. Okay, as the economy slows, companies will remove those job openings, and the amount of people that are unemployed will start to go up as other companies lay people off, as they cut costs going into a slowdown in the economy. That will cause that imbalance to start to, shift. Okay, let's just, for easy math, okay, easy math, 3 million job openings. Okay, let's say you have 2 million job openings, 1 million unemployed. Okay. That is what you have right now. It's not actually 1 million and 2 million. I'm just using easy math for the sake of the conversation. There's 2 million open jobs, but only 1 million people looking for a job. Now, as the economy slows, the 2 million open jobs turns to 1.8, and the unemployment goes to 1.2, and then 1.6 and 1.4, etc. Okay. And then that buffer is extremely important when you talk about this recession that is coming, if not is already here. That is very important. Question number 2 that I get from people: what's the best way to stay dialed in to real-time news and earnings updates while working a full-time job? Because everybody wants to know, like, hey, I'm working a full-time job. I know earnings are important this week. How do I stay dialed in? You use our Benzinga newsfeed and you use our mobile app. Our mobile app that is free with your membership will let you see the screen share, participate in chat, and also listen to the audio analysis as the moderators talk to you on the microphone throughout the course of the day. Make sure you have them. You're connected to our mobile app. I understand some of you can't be in front of a computer. That's fine. You don't have to be. As long as you have a mobile phone, you could be connected to our chat room. So be connected to that, because the moderator is going to give you real-time analysis after earnings come out and what's going on in the day. Also, the Benzinga newsfeed. The Benzinga Pro newsfeed, it's free with your membership to TradingView. It's on our platform. If you went to Benzinga, it's going to cost you like over $1,000 a year to have access to it. Okay. It's free with your membership to TradingView, but it also has a Squawk box feature. The Squawk feature lets you turn on your speakers and you can just listen as someone will read the news headlines to you out loud. This is how you guys can stay up to date with earnings and guidance and everything else, because that's one of the biggest catalysts for the next 2 weeks that I'm going to be focusing in on this market for. Okay. So earnings and guidance is going to dictate my trading. If I'm going to be long or short, I'm leaning towards the short side. to start this week, and I'm going to see what kind of earnings and what kind of guidance that I get from the early companies that start to come out. And if everybody forgets JP Morgan and Citigroup's earnings and everybody starts focusing on other companies that are revising guidance lower. So that's what I'm going to be paying attention to this week. That's how you guys can stay on top of it. All right. Question number 3 that I get asked a lot is, what is the most important lesson of any trader or investor that what should they know and why? I'm going to talk specifically about, I'm going to break this up in 2 different ways, because what's the most important lesson for any trader? What's the most important lesson for any investor? For any investor, I've talked about it a lot during this live stream. It's about being greedy when others are fearful and not doing the exact opposite of what you're supposed to do. Every single time in history, go back and look, don't take my word for it. Every time in history, not 80% of the time, not 90% of the time, 100% of the time, whenever the S&P 500 has gone down more than 20% in 1 year, it proved to be a buying opportunity. 100% of the time. Don't believe me? I don't care. I'm just literally giving you the charts don't lie. The numbers don't lie. Go look at a chart of the S&P, line up the S&P with every single recession that we've ever had. And then you see for yourself, if every single time you had a 20% drawdown in the markets or more, if you bought that year, how would you be doing 1 year later, 2 years later, and so on? Not 80% of the time, not 90, not 95% of the time, 100% of the time, it proved to be a buying opportunity. So if you're from an investor standpoint, always remember that. As a trader, most important thing for you as a trader is simply risk management. I'm not going to come on here and I'm going to boast about, oh, this is how much money that you make when you write and blah, 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 blah. What I'm going to tell you is the not so sexy part of trading, but it's the part that actually will help people be consistently profitable. And that's risk management. You have to lose less when you're wrong than you make when you're right. And that's a problem for a lot of traders. A lot of traders lose a lot more money when they're wrong than they ever make when they're right. And that's a problem. You can't lose $500 when you're wrong, but only make $350 when you're right. You'll never be consistently profitable that way, because now you need to have an 80% win rate just to break even. And you can't have a 95% win rate. You have to lose less money when you're wrong than you make when you're right. You got to lose $350 when you're wrong and make $450, $500 when you're right. That's what you have to do. That's what I'll teach you guys how to do inside of True Trading Group. It's risk management. Without getting into too much detail about the risk management, it's one of the biggest things that I learned at my time at the hedge fund. I used to have terrible risk management. I used to have no discipline. I used to have no patience. And I'm a completely different trader than I am here now today. And I learned a lot of that from my times there working at the fund in New York. And that is I'll never forget it. My boss and my mentor, one very famous quote. And that quote was, successful traders are more concerned with how much they're going to lose if they're wrong. Struggling traders are more concerned with how much they're going to make if they're right. And that one quote changed my entire life. And it did change my entire life because it changed all of my trading. Next question. Will the jobs market get weaker? And if so, does that change your opinion on this opportunity? Not at all. Yes, I do think it will get weaker, because I do think that we're going to be going into a recession, but it doesn't change my thoughts. It's like, I think it's needed. I think it's necessary. You need some destruction in the jobs market in order to help rent prices to stop going up and to slow down the economy. So I do expect the jobs market to get a little bit weaker over time. That's what happens during a recession. Unemployment starts to tick up, but the jobs market is at such a tight spot and it is so damn strong right now that provides a very nice buffer. And that's why I think this is not going to be a job recession. I just think it's going to be a GDP recession. It's going to be an economic activity recession without the major impact in the jobs market. You go back and look at every single other recession that we've ever had. We were never going into the recession with the jobs market as tight and strong as it is, with 3.6% unemployment. It's never been. That's a major, major, major bonus that we have going into this. And that's why I think it'll be a mild recession, which is not the end of the world. You got to realize the economy was going 120 miles an hour last year, coming out of COVID, with all the free money and stimulus, and everybody locked up for 2 years. It's okay to slow down from 120 to 75. If you're going 75 miles an hour, you can still get to your destination in perfectly good time. And that's what I think this recession is going to be like. Will it be a slowdown? Yes. But are you going to lose control and crash into a ditch on the side of the road? No, I don't. And if you're waiting for that, I think you're going to be waiting for a really long time. Last question I get a lot. Can you get started with a small account? What is PDT, and do I have to be above PDT to start trading? I get this question asked all of the time. And no, you do not. Okay, no, you do not. Very, very big misconception that people have is they think that you need tens of thousands of dollars in order to get started trading. You guys don't. it's only if you want to be above PDT rule on a margin account, you got to have over 25K on a margin account. You can avoid PDT by just using a cash account. Use the cash account. Okay. You won't be able to get margin, but you can trade with the cash you have available in your account with as many times as you want. No PDT rule. For those who don't know what PDT rule is, you can make 3-day trades in a rolling 5-day period. That is what PDT rule is. You can only make 3-day trades in a 5-day period. That's only if you use a margin account and you have less than 25K. Use a cash account. You don't need 25K. You can trade as much as you want as long as your cash settles. Okay. So it's going to be when you trade stocks, it takes a couple of days for the cash to settle. So let's say you have $1,000, you put $250 into a trade. It'll take a couple of days for you to be able to use the $250 again. So the next day, you can still trade as many day trades as you want, but you're only going to have $750 to trade with. Let's say you use another $250. The next day, you only have $500 to trade with. And then the next day, that $250 that you originally used will come back and clear and settle, and you can trade with that $250 then again. If you trade options, it's only 1 day. Okay. So if you guys have small accounts, my suggestion would be for you to learn how to trade options. We'll teach you as members of True Trading Group. We have a lot of our members in True Trading Group that when they first joined, they had less than $1,000 in their account. We have a lot of members that started with just a couple $100, guys, and they grew those accounts up to 5 figures. So some members, if you are a member, you started with less than $1,000, you can comment in chat maybe what you started with.